Thanks for clicking. Canada's fixed mortgage rates plunged downwards in November, as the yields on 5-year government bonds fell almost 40 basis points since this point in time last month. And the drop in rates comes as new data shows that fixed rates remain the top choice among Canadians, even with growing predictions that the Bank of Canada is going to have to lower interest rates in 2024.
It is a mathematical certainty.
Given that, absent a surge in inflation, potential rate cuts are going to continue to dominate the narrative, it's worth taking a look at whether or not fixed mortgage rates still make sense. So what I want to do today is go over my best fixed mortgage rates for the month of November, take a look at the current variable v fixed landscape, and then discuss some external considerations which are completely omitted and massively important to the Canadian mortgage narrative. The end of the month is fast approaching, and with that we are eagerly awaiting the release of November's real estate data coming out from the local boards within the next week or so. We'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. Onto the mortgage rates. First up, my best 5-year fixed insured mortgage rate. An insured mortgage rate, that's where you have less than 20% down, you have a 25-year amortization, you qualify at the greater of the contract rate plus 2% or 5.25%, and you pay the mortgage insurance. Insured mortgage rates plunged downward in November. My best 5-year fixed insured in September was 5.64, which jumped up to 5.84 in October, and is now down to 5.59. with a variable sitting at prime minus 0.95% or 6.25. So that's a 25 basis point drop in insured mortgage rates. Still over 5.5%, but a 25 basis point drop nonetheless.
It's go time.
And while insured rates dropped by 25, insurable rates dropped far more substantially. Insurable mortgages, if you'll remember, that's where you have that 20% down. You have a 25-year amortization. You qualify at the contract rate plus 2% or 5.25%, whichever is higher, and you don't pay the mortgage insurance. My best 5-year fixed insurable rate in September was 6.19, which jumped up to 6.39 in October, and is now dropped downward to 5.84. with a variable rate sitting at prime minus 0.5 or 6.7%. So that's a 55 basis point drop in the 5-year fixed insurable rate, now lower than it was back in July when it was sitting at 5.89. And uninsurable rates dropped as well, though by not nearly as much. An uninsurable rate, if you'll remember, that's where you have a 30-year amortization or you take money out of your house vis-a-vis a refinance or an equity takeout. You qualify at the greater of the contract rate or 5.25%, and of course you don't pay the mortgage insurance. My best 5-year fixed uninsurable rate in September was 6.29. That jumped up a bit in October to 6.39 and then fell back marginally to 6.34, with a variable rate sitting at prime minus 0.15 or 7.05%. So rates are coming down all across the board, with the biggest mover being the insurable rate, where you qualify as though you're paying the mortgage insurance but you don't actually pay it, down by 55 basis points. With that said, according to a recent CMHC study, borrowers, though less so as of very recently, have been opting for shorter terms. On a 1-year fixed right now, I have 7.27, 2 years is sitting at 6.92, and 3 years sitting at 6.53. Yet, with so many predicting that the Bank of Canada is going to be cutting rates by early to mid next year, some are arguing that now is the time to consider a variable rate mortgage. And clearly, the real estate industry is where you go for rate predictions.
This time it's different. Is it?
Regardless, let's take a look at how the variable landscape has changed over the past few years. LACKIE, a real estate agent that writes for the Toronto Sun, recently noted that back in early 2022, no one could predict that Canada's key interest rate was going to go up to 5%. Early 2022, that's when the inflation rate was sitting at 5.1% and heading higher, and despite evidence that over the past 60 years the prime rate had almost always been higher than inflation, no one could have predicted that rates would have gone higher than the 0.25 they were back then.
I found this thing, right, called the internet.
Regardless, things have definitely changed since 2022, with Canada's CPI now sitting at 3.1%, and the Bank of Canada's prime rate well above it, sitting at 7.2. Unlike 2020, 2021, and 2022, rates now do have plenty of room to go back down, and inflation is no longer breaking any multi-decade highs. So, what does the difference look like right now between taking a fixed rate mortgage and that of a variable rate? Right now, the benchmark price of a home in Canada is sitting at $745,800, and as mentioned, a decent 5-year fixed insurable rate is 5.84. If we use CMLS's mortgage comparison calculator, link in the description, with 20% down on a 25-year amortization, we can see the initial differences, with the monthly payment on a fixed rate sitting at $3,760 and $4,103 for that of variable, or about a $340 difference. However, according to the Bank of Canada's latest market participant survey, rates are expected to drop to 4% by the end of 2024, with rate cuts set for April, July, September, and one more in the fourth quarter of next year. If that happens in those months, borrowers are still saving almost $1,500 on that mortgage. However, if we get one more cut, say at the beginning of 2025, then the savings flip, and the variable option becomes less expensive. So, with fixed mortgage rates where they are right now, we would need to see 125 basis points worth of rate cuts by the beginning of 2025 to make that option initially worth it. What happens after that in 2025 and 2026, I think, is far too out for anyone to offer any type of accurate prediction. I think even the next year is still massively uncertain, and I'm only using the market participant survey as a baseline, for example purposes, so we're not just pulling numbers out of thin air.
What's wrong with that?
And even then, this survey has been drastically wrong before, predicting last year that we'd have a 4% policy rate by this point in time this year. Regardless, that's the bet being made when choosing a variable rate option over that of a fixed. 125 basis points worth of rate cuts coming from the Bank of Canada by early 2025 to make the variable option worth it. And then, what happens after that is way too far out to make any type of predictions. As we've talked about before on this channel, over the next year, the US is set to borrow $7.6 trillion to pay back existing debt, borrowing new money to pay off old money. And that's not even to mention the additional roughly $2 trillion that it will need to fund its deficit, which, all things being equal, will push up yields on the long end of the curve, or push up borrowing costs for fixed rates. And the reason why I mention this, the reason why this matters, is that, as so many have learned over the past few years, with variable rate mortgages, you can always lock in at any time, but the rate at which you can lock into is not guaranteed. That's all based off the bond market. I've spoken to many borrowers who took out variable rates in 2020 and 2021 and were told that they could always lock in their interest rate. However, what they weren't told was that that rate could be much higher, which the data appears to show could very well be higher as US borrowing costs go up and up and up. So, all things being equal, if the CPI continues its downward trajectory, then we very well could see rate cuts by the end of 2024. And if we see 125 basis points worth of them, then that could make the variable option much more attractive. However, what happens next is anyone's guess. If there's one thing I've tried to stress on this channel, is that the so-called experts, the local experts in the real estate industry, have been wrong time and time and time again. The only certainty you have is your budget. If your budget can take those higher payments over the next year, year and a half, in the hopes that rates do come down and come down enough to make the variable option worth it, then it might be worth considering a variable rate, especially if the budget can take rates going up, which is not out of the realm of possibility. However, if the budget is tighter over the next 3, 4, 5 years, you want that certainty of a fixed payment, then it might be worth locking into safety. With that said, as we saw today, fixed mortgage rates are falling, and if they continue to do so, that could definitely change the calculus even more. We will continue to track Canada's mortgage rates on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.